Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, really any kind of real estate investor, you are in the right spot because every single week on the Gray Report, we are digging deep into all the latest research reports, articles, kind of all the data that's coming out surrounding the housing industry with a specific focus on the multifamily industry, kind of commercial real estate, a little bit on single family, but then just the macro economy in general, especially right now in the past year or so, these macro trends. Inflation, interest rates, they've been moving markets. So it's important to track it. Strap yourself in. We got a lot of great reports. RealPage, S&P, CoreLogic, Marcus and Millichap, Apartment List, Redfin, Real Capital Analytics, Newmark, maybe, and then Market Watch talking about Fed tightening. Let's get into it. Matt Bossnagel's here. He's going to help us break it all down. Let's get into the report. All right, welcome back to the report. Matt Bossnagel, Director of Communications and Marketing here at Gray Capital, back with us. Matt, how's your week been so far? Short week, but
yeah, it's been good. Came off a nice good Memorial Day weekend. It's pretty nice.
Be able to kind of rest, reset.
Oh yeah, very much.
Recharge.
I was dying to get back to work.
Yeah, I mean, I tried to not work that much over the weekend, just was like needed a good break. But I'm excited to get back to it as well and kind of get back into talking about what's going on in the market. Today is a relatively big day, not just for real estate, but for financial markets. Because the Federal Reserve, we've gone from QE, quantitative easing, to quantitative tightening. So going from buying assets, buying bonds, mortgage-backed securities, bunch of treasuries. Now the Federal Reserve is selling that. They're liquidating parts of their balance sheet. Kind of a portion of the time they're going to be ramping up how much they're going to be selling. A lot of treasuries as well as some mortgage-backed securities. To me, Matt, it was crazy to think that in a high inflationary environment where the housing market is going gangbusters, they were still adding extra liquidity into the system, not too long ago.
Yeah, I thought their timeline for this was I don't think overly generous. I don't think that the markets are really reacting with like fear or horror. If anything, it seems like they're ready for a little more tightening.
Yeah, I think this has been pretty well kind of signaled and communicated that this was going to be the case. This is what's happening. Don't need to go into all the details, but yeah, QT may add to upward pressure on real yields as according to Wells Fargo, their investment institute. So I think the question here is, without the Fed again continuing to pump liquidity into these markets, being a buyer of these bonds, which is going to lower the yield and raise the price. Now we're seeing the opposite. So we should be seeing yields rise as they're selling. We should see yields. We've already seen interest rates rise. The question is, now that the biggest buyer of these treasuries and mortgage-backed securities has left the market and is actually selling into the market, are we going to see a further increase in rates beyond what we've seen today? Because, rates are, still, real yields are still quite negative. Even as they've risen, they're still not, even where they were in 2019 levels. And with inflation, hovering around 8% or so, they're grossly negative. And I think a lot of people are wondering, when the kind of the 10-year is going to start getting closer to the actual inflation rate.
Yeah, I was just talking about that about these situations where you buy an asset and you don't get any income from it, and you have to wait till you sell it. You may make a lot of money when you sell it, but there's some strangeness there. Yeah, and I think a lot of people now are used to it. They'll get maybe a crypto coin, and that's not going to give them any income.
That strategy is what's really is shifting. Because that's been the trend. What has been the trend of we'll just bet on future growth. Because there's not that much inflation in the economy, and whatever amount that growth value is going to be worth significantly more. But now, since the dollars in 5-10 years are going to be worth less if we have a high rate of inflation, that growth is significantly discounted. And so we're seeing investors kind of across all asset classes looking at assets that are producing income today, generating a return today, rather than speculating on a return, years down the road. And that's where, dividend producing stocks are becoming more popular, value stocks. But then in real estate, just as a whole, as an asset class, becoming more popular because it's inherently usually income generating. But even inside the real estate world, we're seeing a shift from markets and strategies that are much more focused on long-term growth potential, cap rate compression, that maybe not be throwing off hardly any cash, to now to strategies that are throwing off, relatively much more cash flow or some cash flow, relatively moderate cap rates. And that's where we're seeing, a rotation, into the Midwest, into some more of the secondary and tertiary markets in the Sun Belt in the Southwest. Folks that are really kind of chasing yield, because again, if your apartment community is only earning, if your investment in multifamily deal is only earning, 4 or 5%, you're losing 3 to 4% on a real basis, at least on cash flow, to inflation. Now, there's other, you're paying down the mortgage, there's other return metrics that allow your return to be actually positive, but you have to question yourself if inflation's at 8%, your investment's only putting off, 4 or 5.
Yeah, it is interesting. I think that this was getting my head into like the multifamily world. There was a lot of markets that were growing. And if you had projected the same kind of growth from 2021 into 2022, you'd have a problem no matter if the Fed had tightening or not. There's just some of that growth was unsustainable. And then you add to that math that doesn't work from a perspective of getting a loan versus, that balances with your yield. Then you're really counting on, some of them, I bet that there were some of them that were underwater in the sense that they, the yields were negative. Not underwater in terms of debt.
But they're using, but to your point, Matt, a lot of groups now are using negative leverage. Yeah. And so really that debt isn't really helping you return that much until you grow out of it. And that's where a lot of people are saying, we are growing out of it. We can grow out of it. And just how much time and how much you want to speculate on your ability to grow out of it. Because just what you were saying, if you use some wrong assumptions and you assume too much growth for too long, you don't grow out of it.
And I think that this mortgage thing could be a real big mover in terms of like a wake up call. Instead of their projections, having something that's near term, those loan payments, that's a real thing. That's not just a difference right away. Hypothesis, because there still could be the growth there, but when you're facing such a sharp shift, then that could move people a lot more than maybe a slow changing circumstance in the hot markets.
Well, as they say, as the tide goes out, you can see, really who's swimming and who doesn't know how to swim. Because it really exposes who's doing real deals and who's just been doing deals because an insane amount of growth, but just artificially low interest rates that you can make just about any deal pencil, buying at a low cap rate. But now who's actually doing good deals? And there are still good deals out there. You can still finance a property. You just have to do it the right way.
Yeah, that's a really good point. And I think you said that like months ago, how some people they may not have done all of their due diligence, but they're still making a lot of money because the market was so great.
Yeah, you can buy anything. Yeah.
Now skills have more of a premium and experience and making those good decisions.
Yeah, I agree. And it was difficult because things are moving so fast, and so there was this like decoupling from like any kind of fundamentals or like buying under replacement costs. Was people didn't know what replacement cost was, and prices were moving so quickly. There was a lot of deals that were trading well above replacement costs that didn't make too much sense, other than if you could get an incredibly low interest rate, you could make the numbers work, but are you really making a good buy on fundamentals? Yeah. And I think one of the more refreshing things to all this kind of uncertainty and madness is, in a sense, it's sort of a return to some degree of kind of economic fundamentals, because it's like all of a sudden these things actually do matter.
I was going to say now we have consequences.
Exactly.
And I always thought too, in general, that that at least a lot of the the stories that you have when you're making the deals, it's not like investors were gobbling things up. They were still using they were still going to math, but like the numbers kept creeping up, and it just seems so unsustainable.
Yeah, I think there's a degree of FOMO in 2021 also. People not doing deals in 2020, and then once everyone saw these made big headline rent growth numbers and cap rate compression, everyone's like, we got to get in because I want to lock in this cheap debt. And there were a lot of good buying opportunities if you could lock in some incredibly cheap debt. But I think it kind of put a fog of war out there. You weren't really sure what you were buying. But let's look at kind of the multifamily industry in terms of, kind of on the development side, looking at the supply side a little bit, because it looks like, according to RealPage, the residential permitting pauses, on the single family home side, but multifamily starts. Sorry, just the permitting has paused, but the starts are really increasing.
Just again, top line numbers here. Single family permits are down 3.6% since last year, but multifamily permits are up by 16.3. Permits are just one stage of a process that takes a year and a half to 2 years really to complete, maybe more on the multifamily side. But starts are stage 2. That means they've broken ground on construction, and single family starts are up 3.7%, and multifamily starts are up 42.3% since last year. Now, the third stage, which is completions, you see a different moment, really. Multifamily completions are down 33.3% since last year, and single-family completions are up a tiny bit, 0.7%. Both multifamily and single-family completions were down for the month, with single-family down 4.9, multifamily down 6.6%. We're permitting, we're starting. We're not finishing yet.
Yeah, it's taking longer to get these things actually built.
And there are a lot of confounding variables, I think, here to fully explain completions. Like, the majority of these houses and apartments were started a year or more ago, and the obstacles to construction continue to make building slower and more expensive. There's a lot of regional variability. There's a lot of things that you can't say, okay, the completions of this month were the starts of a year ago, or the permits of a year and a half ago. It's not. I couldn't do that. I looked at the tables for it. I just couldn't. I couldn't do that. I think that there's like a lot of factors that are market specific too. That could mean that some places have a better labor market, have a better, in terms of even logistics and commodity prices than others. So it's hard to say completions and explain them, but they do tell a story in and of themselves. A third less multifamily units were built last year, and just 1% more single family homes were built compared to the year before.
That's interesting, because I think that kind of goes against some of the narrative of I think a lot of people admit that we don't have enough housing, but I think that also a lot of people were saying, oh, we're building way too much right now. Just seeing anecdotally, I see construction going on, I see some cranes in the sky, but we're still falling way behind.
And this is one of the themes really for many of the articles and reports from this week, is that construction of housing continues to be problematic. It seems almost like it's getting worse, but there's still barriers.
Well, and the concern is that the builders are slowing down because of rising mortgage rates. Commodity prices are still high, and they're worried. How much do I want to be building? Going into a potential recession. If there's going to be one or not. When we still need the supply of housing, we still have a big hole we're trying to fill.
And that's why I wrote here. There are still not enough houses and not enough apartments to satisfy demand. The houses and apartments are being built, but they're not finished yet. And so, yes, there's promise in the pipeline, but it's still like there's, even if we finish all the houses that we're building, we'd still need more. And the construction that's ongoing is still ongoing. So we've got a little bit to dig out of.
It'll be interesting to see once that big bulk that is under construction, once it finally, if ever, gets delivered, just what the absorption looks like and what type of market environment it will be when those deliveries are put on the market.
And that's another guiding question that I had for these reports is what about slow home sales and high home prices? Is that going to drive multifamily growth, or are we at an intermediate point in a changing housing market where housing prices as in general may go down? I don't think, at least the story that I've heard, and this is maybe a bias towards multifamily, but are people holding off on buying and they're renting instead, because multifamily demand has not gone down in the same way that home sales have gone down. And as we'll see in the other reports, home prices haven't really gotten a huge hit either. So
no, I mean, with the prices are still growing. And I think it's a good point. But I think for not everyone, most individuals, can't afford to buy a home. It was hard to buy with 2%, 3% interest rates. Now you're paying 5.5% to 6%. That's just completely unobtainable. Your mortgage, the price, your mortgage payment's gone up 30 to 40% year over year. So most people can't afford that, and so that's forcing a lot more people to be renters longer. And there's people who have sold their house, and they can't find somewhere else to buy because they sold their house at X, and now it's now the price to buy something new is X times 30 130%.
And that's what, I think that people, they don't want to sell because then they got to go buy again. You don't want to buy if you've got this bad, you're going to get a bad or a worse mortgage. But
and that's even if you could find something.
Yeah,
it's not like there's that much inventory, and so you have to be very competitive, put a lot of time and effort in. Pay up, pay whatever, still over asking. I mean, again, this is anecdotally, but I'm still hearing reports people paying $25-$50 over asking, just to get a deal, and they're having to do gap appraisal, coverage of where they're going to have to bring more cash to the closing table if the home doesn't actually appraise. Just to be able to win the deal. And so the demand is obviously still out there. At what point you would think that there will be a point where that decreases, but it's also every single day there's just a couple more basis points of the population that is a renter by necessity rather than by choice. I'm
seeing a little bit of cracks, I think. In housing prices and how many, but still nothing. Those cracks are not big enough to be seen from the bird's eye view that these metrics will measure. Housing prices in general, there's a lot of momentum behind that, and it hasn't really dented it. Yeah. Well,
and again, going back to Fed tightening, and selling off those mortgage-backed securities, what is that going to do to the financing market? Is it if there's less liquidity to finance residential housing? We're going to see rates move up even further, which would make sense. But then, is it going to? There's just less liquidity, maybe even harder to qualify as a borrower. If they really tighten things up.
Yeah, that's a really good point.
So, and again, I think that's going to be a driving people into rent. Now, on the extreme case, you're going to get people because rents are obviously continuing to go up, and certain rentals are pricing people out. And so you either have the option of going down in class, finding something cheaper, maybe in a less desirable part of town, slightly older property, or you move in with roommates, or you move in with your parents, and that's where we're going to see some negative consequences of maybe people saying, "Hey, I want to buy, but I don't want to rent. I'm going to move in with my mom and dad."
Yeah, that's why a part of me does think that we are maybe in this weird intermediate point. It's not like anything could happen, and there are multiple trajectories and ways to kind of prepare against this, but it'll be interesting in the next few months. Really, we'll start to see and gather more data about where things are going to.
I think people are starting to bump up against the ceiling, especially with gas prices and the cost of everything else. There's only just so much, and people are prioritizing, food and shelter. I mean, we saw that in the pandemic. I mean, that's what people want to make sure they pay before anything.
And if we're still talking about selling homes, and there might be people that are holding off that are holding off for only some time, and there's going to be a time when people need to sell a house and they can't wait any longer, and that will be interesting to see. If they need to sell that house, are they going to take that price down by 50,000 or 100,000?
And what do you think is going to be what's going to be the point of what's going to make someone need to sell a house?
Well, if they get a new job somewhere else, basically, or for all those other reasons where they kind of have to move somewhere else. But local moves. That will be another one interesting to track, is how many home sales are based on a city to city move versus
because a lot of people, if they've bought a house recently, they don't want to move, they don't want to sell because they've locked in this incredibly low interest rate.
Exactly.
And they're looking around, they're looking at their pretty low monthly payment on the house that they bought that has now appreciated in value. And they've got a low payment compared to what they could go get. And why would you're locked in at a great payment? Why would you put yourself in a situation where you're just paying more interest? Unless you really just bought the wrong thing.
That's I think is like the biggest motivation for me. But that's that's kind of beside the point.
So we're not still building not building enough single family homes. Still not building enough apartments. People are going to be staying put in their single family homes. It seems like quite a bit a recipe for more renters for quite a bit of time.
For sure.
So just more information, just looking at S&P CoreLogic, the Case-Shiller National Home Price Index. Again, this is the index that tracks kind of national home prices. 1 year, 20.5% return.
Yeah, and if you look at the 5-year, 10-year, you really see that that the growth in the home prices has really continued at the same level that began since the early days of the pandemic. This is interesting, and this is from National Association of Realtors. Home sales actually are down 3.9%, which marks 6 consecutive months of decline and the slowest pace in nearly a decade in terms of home sales. And that's for factors that we've talked about just now. It's like buyers maybe they're not interested in selling. But when that balance maybe come from, I'm sorry, sellers aren't interested in selling.
Yeah. But if there's no homes, because there's no home, sellers aren't interested in selling, and then there's just no homes to buy, and so it's not necessarily saying that demand is low as much as supply. It could be demand also, but I think it's more supply oriented.
Oh, I think so too. And it's creating, it's kind of tightening that nozzle and keeping demand high, because there's just less to go around, and that makes sense a little. I still think there may be cracks, but we'll see. And I think that the home prices are a little bit of a lagging indicator.
Yeah, for sure. Because it's such an emotional decision.
Yep.
People, even though it's like the largest financial decision people make, people like throw common sense, and there's like, I don't care what I can afford. I want this house. I want this school district. I want this neighborhood.
Well, and I think it's huge psychological thing is what you mentioned before is, last year they were seeing this white hot growing housing market. They have that number in their head like, oh yeah, I want, people, I need to sell my house when people are going to clamor for it and sell right that day for 20% above asking price. They don't want to enter a market, and who would, that's a little less, maybe we'll still make a money, but
it's still obviously, again, like prices are still up, but it's a little choppier than it was a couple months ago. I mean, we've seen on the multifamily market, it turned not to a full-on buyer's market, but it went from an extreme seller's market to slightly more balance.
Yeah, more rationality.
More rationality. Prices are still up. Cap rates have come off their incredible lows, and people aren't there was just a lot of reaching going on, and people buyers meeting the reach. We're seeing less reaching because less driven by emotions, more driven by, returns and actual, financial analysis. But we're seeing terms become much more reasonable than they were, and really an attractive buying environment. Now, there's still some prices, and there's still some sellers that have an idea that I'm going to get X for it. And I think high quality assets and great locations are still going to be commanding a decent premium. Yeah. Because there's a flight to quality. There, where else are you going to put your money right now? Real assets in an inflationary environment, it's kind of a textbook strategy in move is, again, looking for income, looking for value, and high quality value, though.
And I think there's a good, from in terms of investor demand, there's a good reason to think that multifamily could weather a hit to the housing market in general because of investors realizing, okay, this is an environment where, hard assets are great, but housing maybe a little bit less. Now, there is institutional buyers and investors in single family homes, but that's not nearly the environment of investment multifamily properties.
Yeah. No, it's a good point. All right, let's just pop on again. Looking at pending home sales, we're down a little bit, down about 4%. Is this month over month? Or this is what you were just saying? Over the last 6 consecutive months. It's not necessarily demand driven, although I think you're right, Matt. I think we are seeing some cracks.
And the Marcus and Millichap really outlines this, and I think that there's some interesting, even the little small graph that they had on the article was interesting and a little bit revealing, as you could say.
Home purchases continue to slide, but prices keep rising.
So that's actually what we were talking about just now, home buying, and this is just the beginning paragraph, which I think puts things in really good. And I'd almost like to break it down here. So they say home buying has cooled off significantly, with the overall sales volume shrinking by 15% between January and April 2022, directly correlated to the recent mortgage rate surge. Higher borrowing costs are weighing on buying activity, supporting an increase in available inventory. So, like I said, this lead sentence says so much here. Lead paragraph, whatever. First, a full 15% slowdown in home buying in 4 months is huge, especially since January is not a big home buying month compared to April. Second, it nails down the reason without any wiggle room as directly correlated to the recent mortgage rate surge. And third is their very suggestive phrase, supporting an increase in available inventory. That's kind of the logical conclusion where I found myself after reading about the declining home sales and still elevated home prices, because as we saw in the case Schiller, home prices haven't gone down, not even month over month. Yes, home prices are a lagging indicator, but I also think that the changing interest rate environment, like we said, it has made some sellers less likely to sell. Marcus and Millichap does note that significantly, the amount of home listings has ticked upward since last month, which makes sense because it's the right time of year for homes to be listed.
I was going to say, we're just looking at this chart that Marcus Millichap has. I mean, similar thing happened last year in 21 also. I mean, kind of the first quarter and a half, it was relatively flat, and then home listings, bumped up. Home sales increased after that, and then they did a sharp decline. And now we're kind of seeing kind of a seasonal bump, a very seasonal bump as well. And I would say, I think it's definitely, there has to be a correlation to interest rates, no doubt. But it's also pretty well kind of tracking home listings to sales. I mean, it's kind of a similar trend downward.
And that's what I was thinking. This is kind of interesting, is that home sales were underneath home listings for quite some time before the pandemic. And it's only been since the middle of 2020 where home sales have outpaced home listings.
That's a good point.
And so I think that it could be, that kind of return, and it wouldn't be abnormal if things shifted back to home listings home listings as more than home sales. I think that also this is another figure that I found out here, is that even with the declining home sales and rising listings, the average time a home spends on the market is 34 days, which is lower than any time in the past 6 years. Wow. So even with all of this stuff, and again, these trends
are moving.
Yeah, we're in an intermediate phase, and that time on the market could expand. Yeah. But we are lower than we've ever been, at least lower than the measurement that I found on the Fred website. But yeah, 34 days. That's not so long.
No, that's not long at all.
And just to end here is where I was leading, and especially with that last sentence there, or that last phrase, is this supporting an increase in available inventory. It really comes back to, if sellers aren't selling, then where can we get these new houses? And it has to be through building more of them. And even then, the mortgage rate environment is making builders a little bit more reticent. So it'll be interesting. I still think that the biggest movement will come from constructing new supply.
Yep. I think that's the only way to really move the needle. Yeah. And we just haven't done a good job of keeping up. All right, let's move on back kind of to multifamily, specifically the apartment list national rent report for what is this? I guess we're not in June yet, but this is welcome to June 2022.
Yeah, so they say
we are
June,
in June
and
today.
Then I'm measuring a couple of reports here. So there's a Redfin report that measures the April 2022 rents. They label theirs April, but it came out a couple weeks ago. Mm-hmm. So these two reports, one from Apartment List and one from Redfin, were published about a couple weeks apart. But I think that I want to tackle them as a pair. I think there's something to be gained between looking at, especially ones that measure rents in this way, and they're fairly similar when it comes to the source themselves. So all right, let me just dive in here. So let's go to rent growth. Redfin. I'm sorry, we're starting here on Apartment List. So Apartment List has 15.3% rent growth year over year, which is up 1.2% from last month. Redfin has rents up 15.1% year over year, down by 1.6% from last month. In Redfin's graph, year over year rent growth has increased every single month since April of last year, when it was down by 0.2% from March 2021. So there's a slight, at the same period last year, there's a slight decrease. Now we're seeing a little bit more significant decrease, but that's just how their graph is measured. Still, roughly the same as Apartment List when we're talking about year over year rent growth, all told. Apartment List recorded a dip in month over month rent growth in December of 2021, followed by increasing growth for each month of 2022. Yep. So a little bit different story, but they get to about the same place.
Yep. And I think we've had a rent growth decline since 2008 in December. I don't think there's been a year that we've had positive rent growth.
Yeah, and that's exactly right.
Who's renting an apartment in December?
Yeah. I think a quote from Apartment List points to that, exactly what you said here. It says, rent growth is trending well behind last summer's scorching pace, but ahead of the pre-pandemic norm. I think that rents are not just ahead, they're well ahead of the pre-pandemic norm, but the point still stands. We're not growing at the crazy pace, but we're still growing a lot better than we were in pre-pandemic time.
Yeah, I mean, May according to Apartment List in 2021, I mean, in May we were over 2% of monthly rent growth. In 2022 we're just over 1%. But again, going back to 2019 in May, I mean, we were under 1%. So maybe more normal, but elevated. One trend that I'm interested in seeing how it plays out, Matt, is, again, just looking at the seasonality of, in previous years, kind of the peak has been in May of rent growth. I mean, really, at least in 2018 and 2019, May has been, that's where the peak growth has been. In 2020, we had negative growth, April, May, and June. Within July, things started growing again.
Yeah.
This is nationally, by the way. It's like, Midwest, we saw mostly positive growth really starting in June. But then anyway, on a national basis in 2021, it was a completely different picture, the incredible growth. But the growth peaked in July rather than May. So it really pushed it. It gave us really 2 full months of accelerating growth before it started tapering off until eventually into December, which we actually saw a little slight contraction. But we were still growing in October, almost the same rate that we were growing in the peak month of May back in 2019.
Yeah.
So, so the question that we have is, right now, May's print, we're a little over 1% according to Apartment List. Will we see an acceleration in June and July to outpace May's, or we've hit peak rent growth for the year?
Yeah.
I think, that's going to be all corresponding to inflation. But just because of all we've talked about, Matt, with single family home prices and mortgage rates, if I had to bet, I would say that we are going to see continued acceleration of rent growth for at least in June. We'll have to see about July.
Yeah, this will be really interesting to see. And this is one of the reasons why I wanted to measure these different factors, is because some people see dips where other people see increases. Yeah. So I'm glad I could get a couple here just to compare them once against the other. When it comes to markets, actually, I just want to flying through here on the Redfin and Apartment List. When it comes to markets, the top 3 Redfin markets are Austin, Texas, Portland, Oregon, Fort Lauderdale, Florida, with 46%, 33%, and 31% rent growth, respectively. That's for the Redfin. Now, for the top 3 Apartment List markets, it's Miami, Orlando, and Tampa, all in Florida, which is 28, 26, and 24% rent growth, respectively. The numbers for these markets are different, and there's different markets. Just for fun, the top 3 markets in last month's Yardi Matrix report were Miami, Orlando, and Inland Empire at 24, 20, 24.6, 24.1, and 16.8% rent growth. So slightly lower than the numbers from Apartment List and Redfin, and their average is 14.3% for the rent growth for the whole country. Now, does that mean that no single report is perfectly accurate?
What do you mean? Data isn't 100% correct all the time?
That's right. It's strange, except for maybe the gray report. Report is perfect.
Well, I think it's important. You need to have not just information, you need to have the right information.
Yeah.
And being a little skeptical, or not just taking everything at face value, and because what's the methodology, what's where are they getting this data actually from, and then what's the analysis. You're
gaining a lot more than the numbers themselves if you're looking at trends and you're comparing them with other reports. Each of the reports that we cover here, no report's a real stinker.
Yeah, well, and we've even had some reports that we just said these are flat out wrong. The data is either old, or they just got it wrong, and they're looking at the wrong data.
But they may, maybe their core numbers are wrong, but they're tracking a trend that is worth watching in another one. And especially it's worth reading these reports because, for one, they're flat out different in a lot of them. And if you can corroborate similar trends and similar numbers, then you can get a sense that, maybe this report has rent growth is always generally really high.
Yeah.
Or this report's really slagging on one of the markets here. So you got to just know, what the outliers are.
And that's what we're here for, man. We're trying to filter through the noise, trying to pick out, identify what's important, maybe what's not. So again, if you're not signed up for the newsletter, graycapitalllc.com/newsletter, you get these way more reports into you every single week. Highly valuable resource. I recommend checking it out. It's in the show notes, but you can go to graycapitalllc.com, point you right to it. Matt, want to move on over to kind of U.S. commercial real estate price growth?
It's a really short article from Real Capital Analytics, and a continuation of a discussion that we had last week about the appreciation of CRE assets. A couple of paragraphs. Just because it's short doesn't mean it's bad. A couple of paragraphs in a nice revealing graph on the 5-year trajectory of the CRE markets at a glance. And they explain the specific numbers in the short summary. Basically, growth has ebbed. Prices themselves are not ebbing. The rate of growth is ebbing. CRE prices rose 17.3% year over year, industrial 26, retail 18.4, and multifamily 23%. Notably, as you can see in the graphs here, multifamily prices seem to have the most stable growth when you look at the 5-year graphs, where the other property types as a whole experienced a clear slowdown in price growth that began in early 2022. Apartment properties have been seeing roughly the same amount of price growth as they had at the beginning of the year. Again, we're talking about the rate of growth, the acceleration of price increases. This acceleration is staying the same for apartment properties. For retail and industrial properties, this acceleration is going downward, and so prices are still going up, but the acceleration is going down.
Yeah. Well, and again, maybe that's a good thing.
Yeah.
As we don't want to get too weak, because again, the prices can just, once they are removed from fundamentals, that's when you start. That's what you really have.
There's
a bubble.
Yeah, that's a bubble, and that's inflation.
Yeah,
basically.
and that's not what we want. We'd rather see healthy growth than just extreme growth that could really wreck the market.
Yeah. So that was just really brief, but I noticed like 2 or 3 full articles that were longer than that report itself based on those figures. So those are really good at a glance, this kind of moment now that we're seeing.
So now we want to bring a little physics and math into it, Matt. Which so we do have a PhD. Matt has a PhD.
Not in physics.
No. Well, I thought we hired you. No. Yeah. No, I think this is fun to look at. You tell us about this, Matt.
So
you tell
we're
us about
looking
this
at
Wikipedia article.
So everyone's like, growth is lower, and it gives people the impression that prices are going down, but really it's the acceleration that is changing, and the changing rate of acceleration is called the jerk in physics. So the jerk is going down in retail and industrial. It's jerking downward. That's the term, and then after the jerk is snap, and then crackle, and then pop. So that's just a little physics
and
facts.
specifically named after the Rice Krispies mascots, Snap, Crackle, and Pop.
Yeah, lighthearted physicists coming up with their own little cute names.
So what are we seeing? We're seeing some jerk right now, but we're not seeing a full on snap, and we haven't seen a crackle or a pop. But we're just seeing we saw the acceleration. Now it's a quick jerk.
Yeah,
but a jerk can. And that's the concern. That can that can be harmful.
Yeah,
you don't want to get jerked the wrong way. You can hurt your neck, but get a strain in your neck. Snapping's even worse though.
Oh man, that's
crackling,
right.
popping. So
I would prefer a crackle to a snap.
Me too. But I guess
those are all things you need to talk to your doctor about.
Exactly. I don't know if those are the best names, so they all kind of sound endearing in a way.
But I do think it is worth keeping that in mind. This idea that we're not changing, the prices aren't going down, the growth is going down, and frankly, it should go down because otherwise, it's just the snowball will be too far.
And I think a slight decline in prices would probably be healthy too. Yeah. I mean, very few things, and again, in the universe don't keep going up on a straight line. Yeah. You kind of have ebbs and flows, you have cycles, and you have periods within those cycles that oscillate up and down, and you have to have. With rising prices, you need to have a decline in prices because typically we overshoot, like would have happened in the crazy environment we've seen, low interest rates. We've overshot. Now we need to correct down.
And the only time that you'd really be scared of it is if you were like trading.
Yeah, short term.
Short term.
Short term. If you have long term, you're good.
Then then you want that rationality.
So keep that in mind. If you can stomach being locked into an investment for at least 5 years. You really remove a lot of risk from the equation.
It's true. Okay. A lot less work, too.
It is.
Maybe.
It is. Now, there's a potential to make more money if you keep turning over deals. But, it's like playing musical chairs. All of a sudden, the music stops. You want to make sure you've got a seat. Okay, so one last just cool piece. We're tracking a lot of, the correlation and the intersection of kind of the industrial, warehouse, logistics, and multifamily. Industrial has been, really the best commercial real estate asset class performing over the last couple of years, driven by e-commerce, kind of onshoring, all this kinds of stuff. In markets that are big logistics hubs, like your Memphis, Indianapolis, kind of the Inland Empire in California, they're getting a lot of attention because they're seeing a huge amount of job job growth related to these logistics industries. And so we're kind of seeing, how the trucking sector trends may impact warehouse location decisions.
Yeah, this has been one of the most interesting developments, I think, in commercial real estate, and there are people, maybe there are industrial real estate investors that are listening
100%.
Right now.
I know there are.
I think that the growth of the logistics industry specifically is a huge driver of industrial growth, and this kind of almost wake up call that we had with this supply chain crisis on keep making sure that things are there on time, and this shift from maybe just on time to just in case or whatever. There are these. Logistics is important. Suddenly, people are talking about the supply chain and not just taking it for granted. And that that kind of goes along with the rising industrial prices, the increased investment in the area, and the jobs that come with it. We've talked about this before. It's the markets with industrial growth that have this. It's a real engine to the economy.
Yeah.
And they pull out several job markets, several markets here that have incredible industrial growth in different regions in the Northeast, Midwest, West, Southeast, and the Southwest. And in the Northeast, it's New Jersey North. In the Midwest, they singled out Indianapolis. The West is Inland Empire, and the Southeast is Greenville, Spartanburg, and in the Southwest is Austin. I just like this because we're from Indianapolis, and this list of major industrial markets includes information on the population size that is reachable in 250 miles and in a one-day drive. So it's a benefit to be in a logistics hub in a market where you can put a warehouse where things only take 1 day to get there, or maybe it's a half day or 250 miles. But I'm assuming that this chart here these are metrics that people go by. Is can you get there in a day? Yeah. How many people can you reach in a day? And for Indianapolis, they score very well in both of these metrics. It's number 2 for 250 mile radius. And of the markets highlighted here, it can boast the largest population reachable in a 1 day drive.
A 1 day drive, 100. So out of Indianapolis, you can reach 149 million people. That's even compared to the Eastern Seaboard, in New Jersey, we can reach about 100 million people. The only really market that comes close is Greenville and Spartanburg in the Southeast. They can hit 125 million people. And so that's why, Indianapolis, and we've talked about this a lot. I mean, we've had a lot of, investment or theses that are kind of surrounding, a lot of these facts. But you can see why so many companies, the Amazons, the Walmarts, major logistics companies are all based out of Indianapolis or have offices. I mean, that's the reason, Matt, why, unrelated to real estate, but, the baby formula shortage. When Nestle shipped in, flew in, or the United States government picked up a C-130 full of baby formula pallets, where'd they fly it into? They flew it in Indianapolis. Yeah. It's because Nestle has their major distribution center just outside of Indianapolis near the airport, and they could get that within a 1 day drive to 150 million people. It's not just Nestle happens to have their office there. It's how are we going to get stuff out to people? Yeah. And being kind of middle America, crossroads of America, you got more of pass through interstates than any other market. That all adds up.
Well, and that's what's interesting too is like you can't change this. You can't change where a city's located. Yeah. Now, the growth of different areas may affect and may mean that the population is bigger in some place down the road, but even their projections is Indianapolis can still reach a lot more people. And, I think when we're looking at new markets, what do we look at? Sometimes we'll look at, where the proximity to other major markets. Oh, sure. Where where do the interstates roll around to? And Indianapolis is really in a great spot when that comes to, but that's relevant for multifamily, but it's also relevant really for industrial, which trickles down, if I can use a fraught word, too. I think it's an engine of the economy that drives housing demand. And so if you see a place where lots of industrial properties are moving in, then jobs are going to move in and people are going to move in.
Yeah. No, I think the kind of industrial investment thesis, it makes a lot of sense. Yeah. I mean, between an trend to buying things online, shipping, everyone's buying everything on Amazon. That's been going on for a while, but now this whole idea of creating more sustainable supply chains and onshoring and not being 100% reliant on, importing from China or Asia or wherever, maybe you'll still do that to have a robust supply chain, but you also want to have options of manufacturing, distributing, in the United States as well, just to have a more robust system. And I think a lot of other countries are going to do that. But that's a whole other driver that's put on top this big push to e-commerce.
Yeah.
So we're, where that maybe wasn't the case 3 years ago.
No, I completely agree. And that is interesting to think about is, we've got these signals, but it takes a long time to get these factories up and running. There's a chip factory that's maybe planned that maybe will get built in 2 years.
Yeah.
But I think a lot of the industrial growth could be due to demand factors that were pre-pandemic. They're just kind of ramping up.
Yeah.
And so, that's a fun thing to watch.
Yeah, it'll be interesting to see. Now, part of that, and this may be a short-term phenomenon, but it's, you certainly can grow a little bit too fast. And I've seen some reports that, Amazon's going to be subleasing some of the warehouse space because they're like, well, we've got all this warehouse space. Maybe people, they're not buying as much random stuff on Amazon like right now because you're paying X at the gas pump. You just have less discretionary cash to spend. That's why we saw reports coming out from like Walmart and Target. They kind of missed their earnings because just people were spending less money on just discretional purchases. And I think Amazon is kind of key to that. I mean, people are doing more staple spending and purchasing on Amazon, but you're not picking up the random gadget.
Yeah, I wonder. I would be curious as why Amazon's selling and why they bought in the first place. What were their projections, or if they were just, let's get as much as we can, and now they're like, well, it's easy to sell.
Is it a long-term play? Like, we need the real estate. Let's lock in, kind of general lease terms now. Control the real estate, and we'll grow into it. We'd rather buy 1 million square feet or a couple million square feet, even though they've got these smaller centers also. But we'd rather buy in bulk, sublease some of it out because occupancies are very tight. Makes sense, but we're going to control the real estate.
Yeah, that makes a lot more sense
to me. That it may not just be, we bought too much, and what do we do with it?
Yeah, that doesn't seem like something that they would do.
It doesn't. So having that more long-term strategy, I think, makes a lot more sense.
Yeah, that's good.
Yeah. All right. Appreciate you watching this episode of The Gray Report. A lot of interesting articles. We're going to try to keep you up to date every single week. Try, again, filter through that noise, help you make some really good decisions. If you'd like to be updated with the full newsletter, again, a lot more reports than this, hop on over to graycapitalllc.com/newsletter. You can also check out grayreport.com. Make sure you like this video. Make sure you're subscribed to the channel and give us a comment. If you're listening on podcasts, we really appreciate it. If you give us a good review, it would mean the world to us. And again, any comments, any good reviews, ask, good question. We'll always feature it, especially if it's a good question. And if you're an accredited investor and, allocating to multifamily seems to make sense for you because we're in a high inflationary environment. The fundamentals make sense. I mean, we certainly think so. You can also go over, just type in your browser, gray.fund. There's going to be a link in the show notes. And if you'd like to, just let us know. We'll send you one of these, full nice decks, kind of giving a nice overview of the Gray Fund, looking at some properties, projections, all kinds of good stuff. We did a great job putting this thing together. So again, get in touch with us going over to gray.fund. We'll send you this digitally, but then you just put a note in saying, hey, send me the physical deck. We'll send you the deck right away. Maybe even throw some cool swag.
Nice cardstock. Yeah. It's a great booklet.
Yeah, I'm proud of it. Great job. All right, guys, thanks again for watching The Gray Report. We're looking forward to seeing you next week.